When the market shifts and interest rates rise, some investors start looking for creative ways to keep their portfolios growing. One of the financing tools that has become increasingly popular in this higher interest rate environment is the DSCR loan. It's designed for real estate investors who want to buy or refinance income-producing properties without relying on traditional income documentation. Let's dive into how this works, the pros and the cons, and why it's helping so many investors, including myself, stay active in a changing market. Hey, it's Mark here with the Hiller Group, brokered by eXp Realty. My team and I have you covered here along the beautiful Florida Panhandle, from Pensacola all the way through Panama City, where our team has been fortunate enough to help over 1,600 clients and sell over $500 million in real estate in the past 12 years alone. So what the heck is a DSCR loan? DSCR stands for Debt Service Coverage Ratio. It's a loan product that focuses on how well a property's income covers its debt payments instead of focusing on the borrower's personal income or employment. The key calculation lenders use looks like this. DSCR equals net operating income divided by annual debt service. In simpler terms, it measures how much cash flow the property produces compared to what it costs to own each year. If a property brings in $6,000 per month in rent, and the total payment including principal, interest, taxes, and insurance is $5,000, then the DSCR is 1.2. That means the property generates 20% more income than it costs to maintain. Most lenders like to see a DSCR of at least 1.0 to 1.25, though some will take lower if the rest of the file looks strong. Traditional loans rely on your tax return, W-2, or your pay stubs to prove your income. DSCR loans, they're different. They're based on property's ability to generate rental income. Here's the general process. The lender orders an appraisal with a rent schedule known as Form 1007. The appraiser estimates fair market rent for that property. The lender compares the projected rent to the total house payment. If the rent covers or exceeds the payment, the property qualifies. That's why DSCR loans are considered asset-based lending. Approval depends on the investment property's performance, not on the borrower's personal income. Many investors also appreciate that these loans can be made in the name of an LLC or business entity, which provides an added layer of liability protection and helps separate personal and business finances. In recent years, higher mortgage rates and stricter qualification standards have made traditional loans more difficult for investors. Self-employed buyers often show less income on paper due to deductions, and those who already own multiple properties can hit conventional loan limits. DSCR loans solve those problems by focusing only on one question: does the property cash flow? Because of that, these loans have become one of the most valuable tools for investors who want to keep buying even as lending environment tightens. Some of the advantages of the DSCR loan are: 1. No personal income verification. You don't need tax returns, pay stubs, employment verification. The property itself tells the story. Number 2, you can close in an LLC or a business name. This helps with asset protection and makes bookkeeping cleaner for investors who manage multiple properties. Number 3, no cap on the number of financed properties. Unlike conventional loans, you aren't limited to 10 properties. This allows investors to scale faster. Number 4, faster, simpler processes. Since there is no income verification, underwriting is often smoother and closings can happen in just about 30 to 40 days. Number 5, works for a range of property types. You can use DSCR loans for single-family homes, multi-unit properties, and even short-term rentals depending on the lender. Number 6, it is excellent for refinancing. Many investors use DSCR loans to tap into equity, especially when a property's value has gone up, but personal tax returns don't show high income. In a higher rate market, those advantages help investors stay nimble while others wait for rates to drop. All right, now let's cover the things to look out for. Of course, no loan program is perfect. DSCR loans come with a few trade-offs. Number one, a little bit higher interest rate. Rates are usually 1% higher than conventional loans. Lenders take on more risk because they're relying on the property's income, not your personal credit. Number two, a larger down payment. Expect to put down 20 to 25%. A few programs allow less, but you'll typically pay higher rates or fees for less than 20% down. Number three, prepayment penalties. Many DSCR loans have prepayment penalties lasting 3 to 5 years, especially if it's structured as investor financing. Number four, stricter property performance requirements. If the rent doesn't cover the payment, approval becomes more difficult or the rate increases. Number five, higher credit score minimums. Most lenders look for a credit score of at least 660 or higher, with better pricing for 700 or above. While these drawbacks are worth considering for a lot of investors, the flexibility far outweighs the cost, especially when the property itself produces steady income. Rising interest rates have created a more complex environment for real estate investing. Traditional financing has become harder to qualify for, and some investors are being priced out of deals. The DSCR loans bridge that gap. They let investors continue to build wealth through real estate by leveraging the cash flow potential of each individual property. Even when the rates are elevated, strong rental demand in many markets, especially along the Emerald Coast, means properties can still generate solid returns. With low vacancy rates and consistent tourism, short-term and long-term rentals both remain strong performers in our region. By focusing on income-producing assets rather than personal debt-to-income ratio, DSCR loans keep the door open for investors who otherwise might be sidelined. Imagine buying a $600,000 short-term rental near the beach. You put down 20%, and your total monthly payment, it ends up around $4,200. If the property's projected income averages $5,500 per month, your DSCR is 1.31, comfortably within most lender guidelines. That means the property pays for itself and generates positive cash flow even in this high interest rate environment. You can continue building equity, and when rates drop later, you have the option to refinance into something lower. If you're considering a DSCR loan, keep these practical tips in mind. Work with a lender experienced in investor financing. Not every loan officer understands how DSCR products work, and experience matters more than ever. Know your numbers up front. Estimate your rent, your expenses, and the DSCR ratio before you apply. Look for markets with solid rent growth. Areas with consistent demand and limited supply will keep your ratios strong. Understand your prepayment terms. If you plan to refinance soon, choose a shorter penalty period. Keep reserves available. Many lenders require 6 to 12 months of reserves, especially for multi-property investors. Following these steps helps ensure your financing works in your favor and sets you up for long-term success. DSCR loans aren't just another niche product. They're just one of the most strategic tools available for real estate investors in today's market. They allow you to keep buying and scaling even when traditional financing is limited, using your property's income potential to your advantage. Yes, the rates can be a little bit higher and terms are different, but for many investors, the ability to keep building wealth outweighs the additional cost. If you're serious about investing, explore DSCR options with a lender who specializes in this space. You might find that your next opportunity is closer than you think, and your property's cash flow could be the key to unlocking it. Hope you found this video helpful, and if you need a great DSCR lender, reach out to me. We've got one that can lend in every state. Hope you found this video helpful, and we'll see you on the next one.